time to get in a big market voice. Nilesh Shah, MD of Kotak Mahindra Asset Management, with us on the show as well. Nilesh bhai, great having you on a day like this. Thank you so much for joining in. You and I can afford a smile, but I'm telling you, a lot of people out there are really licking their chops this morning. How bad is this uncertainty, Nilesh bhai, for risk assets pricing?
Undoubtedly, Neeraj bhai. Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Right. So can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Nilesh bhai, good morning. Hiral on this side. Let's talk about history as well. I mean, tariffs have been levied by the US in the past. We did see that resulting into a recession. How are you looking at 2025 then? Do you think it'll just be a major impact in terms of lower growth and higher inflation, or it could be much more leading to recession or something like a Great Depression that we saw? I mean, is it a good comparison?
So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression without taking appropriate action. At the same time, there are equally opposite cases where levying tariff has resulted into recession in US in 1828 as well as 1930. Now, there may be there may be people who may see that this levying tariff is appropriate from the America's point of view because of fiscal deficit, current account deficit, and debt to GDP ratio. Will it create stagflation in US where growth is lower, inflation is higher? Quite likely, that is a possibility that will lower the global growth. If engine stops of the train, the whole train has to stop. And US is the engine of global GDP along with China and India.
So Nilesh bhai, one aspect that I'm picking up from your conversation right now is how strategically we position ourselves as a country to take advantage of it. So from an investment perspective, which are the sectors that could take advantage of this kind of a tariff war to take business from other countries into us and in turn be buying opportunities for investors?
So one, there is so much of uncertainty that there's no need to hurry to invest. In the hindsight, we may feel, oh, this was a great level to buy. But when there is a storm brewing outside, it's far better to secure yourself and then think of opportunity. Number two, clearly domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economies. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within these sectors which could take advantage of opportunity, as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended. It's not that American buyers will straightway shift from China, Vietnam, Thailand to India. One, their demand should remain consistent. And second, we should have capacity to service them. It's all going to take time. Market does discount future, but it's likely to be more back-ended than front-ended.
Got it. Nilesh bhai, just pure domestic plays. So I mean, you maybe put in cement out there, and I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel, but cement for sure.
So cement undoubtedly is pure domestic sector. You can't export much of a cement. You can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well. And largely, it's a domestic-driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Okay, Nilesh bhai, difficult days, but thank you so much for your wisdom. Really appreciate, and I'm sure viewers benefit from it as well. Thank you.
Thank you.